Good morning and welcome this morning to Trading Futures, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager, and there are the morning bells, and that says that the cash market is off and running. And you're here with me. I'm also joined by my good friend, Michael Fairborn, this morning. Great coach and 20-plus year veteran of the financial markets. He teaches this webcast on occasion if I'm not available. And he is a great resource as well. He's out there in the chat to help answer your questions specific to this discussion, and I'll keep an eye on that chat as well. Thanks for joining me if you're here in the live version or if you're in the recorded version as well. We appreciate you being here, and we appreciate you being our clients and joining us for these webcasts. A couple of things that we want to talk about today. We probably got some metals moving a little bit. We're going to take a look at that. Everything else seems to be, at least at the moment, at least from a equities futures perspective, a little bit flat. We'll see if that holds up. And we'll take a look at what the crude oil market is doing as well. And we're going to jump into this discussion here really quickly as we get started with a couple of ideas around making sure that we take care of some of these housekeeping items. First and foremost, remember that everything we talk about simply for illustrative and educational purposes. Nothing that we talk about should be considered to be any kind of a recommendation or advice about specific strategies, specific symbols, specific markets, or anything else. Remember, the futures and futures options trading involves substantial risk. It's not suitable for all investors. Make sure that you read the risk disclosure statement for futures and options prior to trading any futures products. Remember that futures trading requires separate trading authorization. Futures accounts aren't protected by the SIPC. And also remember that futures margin is something that needs to be taken into account as you trade futures contracts or futures options. So be aware that we've got a lot of resources that can help you to understand that. Now, when we talk about technical analysis today, which we will, technical analysis is one of the ways that we will approach this market. There are other ways of looking at markets and investment research, including probability analysis, including fundamental analysis. I talked a little bit last week about how you can find some fundamental analysis research on futures markets. But remember that those are all theoretical in nature, including technical analysis and including fundamental analysis, and none of them are guarantees as to what's going to happen next. Schwab doesn't recommend the use of technical analysis as a sole means of investing research. We're going to be using the thinkorswim desktop software platform today, specifically the paper money version. It's a great learning environment. It's a great sandbox, but it doesn't guarantee future success out there in the real world. So make sure that you're aware of all of these risks, including the fact that there is the risk of loss, including substantial loss, including more loss than your initial investment when we're talking about futures products. Also, the last thing I'm going to mention here in this discussion is the fact that stop orders, when it comes to futures, are a little bit different. Now, when we're trading equities, there's the risk that the price could move because it becomes a market order, and the price could be continuing to move once it's activated. Now, in the futures market, what can happen is, because of exchange rules, if a stop order is triggered, that order may in fact become a limit order within what are referred to as protection points, a certain range in which the exchange will work the order as a limit order. So there is the potential that that order could get rejected if the market is moving quickly, and there is the very real potential that that order could get filled at a substantially different price than expected when using a stop order or a stop limit order on a futures contract. So we'll point that out as we go through. I don't want you to be afraid of that, but I want you to be aware of the risks and how this works in the futures market. All right, so let's jump into the discussion here really quickly and talk a little bit of where we're going to go. We're going to talk about some futures contracts this morning. We're going to discuss what's going on in the futures market, and we're going to look at some example and illustrative trades. And let's pop into the market here really quickly. Yeah, we didn't go deep, Mark, into that discussion I just pointed out some resources that we can use to learn about the fundamentals, but we're going to talk about some of those here as we get into this discussion today. So what I wanted to do really quickly is take a look at what's going on in the overall market. I wanted to start right here because obviously the one of the things on everybody's lips at the moment, as we take a look at the kind of intraday comparison of commodities and metals futures. Up what we've got up here, we've got crude oil, we've got heating oil, we've got copper, and we've got gold. And I haven't put labels on these, and we can go through and I'll show you that. But I can also share this particular grid as well. But I wanted to see what's going on with metals and with commodities, specifically energy commodities at the moment, just to kind of get a sense of how this market is shaping itself up this morning. So one of the things that I know right now is that this green line is my CL crude oil comparison line, right? So we can go through, and this is a tool that we use on a variety of charts, this comparison line tool, and it's available. You can put these comparison lines on, and you can see what's going on. So what I'm going to do is I'm going to pop up here to the flask icon, and I'm going to come down here to the gear icon. And anytime we see that comparison, that gear icon in the Thinkorswim ecosystem, that gives us the ability to change or modify something. So the first symbol that I've got in this comparison, this is a comparison study that allows 6 symbols to be compared side by side in that percentage value space. So the first one that I've got in this particular case, symbol 1, is well, let's see our color here. So purple, if I look at this first one down here on the plots, purple, I can see the color. Purple is symbol 3. So that tells me that symbol 3 is Hg. That's copper. If I go to the next one, that's symbol 4. And sometimes you have to do that just to kind of get this these labels aligned. So symbol 4 is heating oil. That's orange, or kind of that orangey color. And we go to symbol, this is now symbol 5. We don't have anything. Symbol 6, we don't have anything. Symbol 1 is our green line, and that's crude. And that would mean by process of elimination that our next color, symbol 2 in the blue, is going to be gold. So what I'm going to do is I'm going to just cancel this again, and we're going to go out here. So what I know is that green is crude. So I'm just going to create my labels here really quickly. I'm going to show you how to do this. I'm just going to do /CL. I know that that's my crude contract. /CL. It's in caps. That's my crude contract. And I can match up these colors, but for the moment, I just want to do these really quickly. So /GC. We know that that's gold because we went through that on the chart. /HO is heating oil, and we can see where heating oil is. And now we go /HG, that's copper. And so we can see copper and metals, or copper and gold, both generally declining, right? And heating oil and crude have generally been going up, short-term pullback. This is 15 minutes, right? So this is starting at the beginning of the futures trading process today, and then moving for the last 15 minutes, so we can see what's going on. This is on the Thinkorswim desktop software platform in the paper money version. So what I'm going to do, the other side of this I've got is my intraday comparison chart for equities futures, and I'll show you that here in just a second. But again, same thing. We've got those contracts here, and so what I'm going to do is I'm going to click and I'm going to save this grid as my intraday comp, equities, and commodities. I'm going to actually give you guys a homework assignment. And what I'm going to do is I'm going to share this grid with you. I'm going to go ahead and click on share, and we're going to share this grid, Control V. I'll paste it over here. Remember that anytime we share something in Any shared items are simply for illustrative and educational purposes, number one. Number two, they're not guaranteed as to time or accuracy. And remember that they're dynamic, and so sometimes they may change. So that's something to keep in mind. So I shared that grid with you. I put the labels on the intraday commodities comp. That's the second chart in the grid. The homework that I'm going to give you guys is this. Go to this grid right here. This is the first one in that 2-chart grid. And this is the intraday equities futures comparison chart. So what I want you to do is do the same process that I did. Go to the Flask icon, go to the study here, that shared comparison study, go to the gear icon, and figure out which colors correspond with which symbols on the chart, and then put your own labels on the chart. Now you've got the practice of doing that so that you've got that ability to build your own comparison chart. And this can be a helpful tool to get a sense of what's going on over the course of an individual day. You can see kind of that momentum-driven movement early in the morning or late in the day, or whenever you happen to look at this, you can kind of get a sense of what's going on. So there's your homework assignment. Go ahead and build that. And I also put this in the this grid link in the description for the webcast. So those of you who are watching this on the recorded version, you can get that description, that link off of the description page as well. And you can do the homework the same way. So there's your homework assignment. So now that we've got our homework assignment out of the way, and we'll come back and we'll check on that later, I want to go back here to my futures grid. And my futures grid is simply a 3-chart grid with the equities futures that are primarily driving this market, or at least primarily defining this market, right? So /ES, that's the S&P 500 E-mini futures. And /NQ, that's the NASDAQ 100 futures. And /RTY, that's the E-mini Russell 2000 index futures. Now, there's, I think, an addition that I want to make to this particular futures grid that I don't have on here. And that would be, and this is something that you could do, and I've posted this down in the description page for this webcast as well, is the label, the futures label link that you could put here on the chart that would show the tick size, the tick value, the notional value of those particular contracts. So if you decide to change it, you could add that to that. I haven't done that yet. We'll do that later. But I just wanted to see where the market was going. And what was really interesting to me this morning as I was researching and getting ready for this webcast is that the picture that I'm seeing on both the /ES, the S&P 500 E-mini futures, and the /NQ, the NASDAQ futures, looks almost identical, both from a momentum perspective as well as from a support and resistance perspective. So let's start with the ES, and I'll show you what I'm seeing. I'm really kind of seeing this short little, maybe symmetrical triangle building itself up here and kind of squeezing and kind of going sideways here horizontally, right? And as we look at this, kind of coalescing right around that 50 period simple moving average. And you notice also what RSI is doing, the relative strength index. Relative strength index is kind of that momentum indicator that might give us that oomph behind that movement, right? So it's a Wells Wilder creation. We'll talk a little bit more about Wells Wilder today, but it's a Wells Wilder creation that's giving us an indication of where prices are closing relative to the highs and the lows of the recent days. That's an oversimplification, but it gives you kind of a perspective. So it says that highs and lows are getting fairly close to one another. They were not moving higher. They're not moving lower. They're kind of closing kind of right in the middle of that range. And that would be consistent with this idea here about coalescing right around that 50 period moving average. Everything's kind of coming to a point, right? There's kind of this wait and see attitude. And when we see the types of moves that we've seen in the market recently and the types of geopolitical moves that we've seen recently, it's not necessarily at all unexpected to see kind of that coalescence around that moving averages. There's kind of that wait and see mode. Now, this is a little bit like a horror movie. And I say that not ironically here, in the sense that when volatility drops, when markets, when they condense or when they kind of come together or consolidate, when they squeeze, oftentimes that leads to big volatility on the other side, right? It's kind of like that horror movie, right? When somebody sticks their head out and says, "Hello, guys? It's quiet out here. Too quiet." Because sometimes, right? Sometimes when it's really quiet is the calm before the storm. Not necessarily. Doesn't guarantee it. Doesn't mean that this is going to pop one way or the other. Simply means that there's a kind of a convergence, if you will, of levels of support and resistance. And so price can move potentially to a large degree outside of that range. We take a look at the NASDAQ and we kind of see the same thing, right? So we're seeing the same thing on these NASDAQ futures, on the /NQ futures, coalescing maybe a little bit higher. And that may be the difference here in this picture, a little bit higher than the 50-period moving average, kind of bumping its head against this diagonal resistance level. But we see the same kind of squeeze and consolidation in the RSI generally that we were seeing in the S&P 500, right? And so again, coalescing right around that 50-period moving average, coming to a point, squeezing, waiting to see. But the other thing that's interesting that tells me something here, and I'm going to pop into my grid here. I'm going to just restore these cells. If we were just looking at the ES and the NQ, right, /ES /NQ, and you were to look at the two of those together, right, one of the things that you're seeing is those are very, very similar to one another. Now, I want to talk composition for just a second, because the /NQ, the NASDAQ futures, have typically and traditionally been technology heavy. They are led by, or have been led by, the technology leaders, the companies that have been in the technology space, information technology or information communication space. That's been the biggest weighting of that particular index. So oftentimes the NASDAQ has been A, more volatile, and B, kind of the leader within this space, especially when technology has been the leading sector, which we've seen over the course of the last couple of years, right? With the Mag 7 stocks leading the market. But now what do you see, right? You see that the NASDAQ and the S&P 500, which doesn't tend to necessarily be led specifically by technology, because it's kind of, I mean, it's not equally weighted, but the drivers of the S&P are generally also the drivers of the NASDAQ. So it's been the Mag 7 stocks and others. But you see that reflected in the NASDAQ more than you see that reflected in the ES, because this is A, the NASDAQ smaller index, B, the ES has a broader cross section, has more kind of diversification, if you want to think about it from that standpoint. But when these two start to move in conjunction with one another, right, where there's a strong correlation and they kind of look the same, what that tells me, in kind of doing a back of the napkin intermarket relationship or intermarket analysis, is we're losing, or have lost, the market has lost the leadership that was maybe being displayed by the NASDAQ. Meaning, maybe the Mag 7 stocks are not leading the overall broad market as much as they were before. Does that make sense? So if that's the case, then that maybe suggests that there has been some rotation going on. Now, if we start to see the NASDAQ break out and lead out ahead of the S&P 500, that would maybe suggest some rotation back. So now we've done a little bit of intermarket analysis this morning just to kind of get us on track. If we go back over, I'm going to pop this back into its maximized view so that we can look at these individually. Now we're looking at the Russell 2000. And in fact, we went, if we remember correctly, we go back to the monitor tab and we were short the M2K, which is the micro-sized E-mini Russell futures, looking at taking that to the downside. We entered the trade at around 22.66. It's now trading at 22.83. So we're losing a little bit in this. In fact, in today's trading, we're losing it a little bit. We go back to the chart, and we were looking at this downward movement, right? Bounce off of the 50-period simple moving average here. We see that rolling over a little bit, so seeing a little bit of that weakness. The 200 period is still moving to the upside, but RSI is still trending down, and it's running into this resistance level. So while we entered lower and we saw that little bit of a bounce, so we entered perhaps back here on the 4th, as it was running its head into that resistance level, and we saw the RSI moving down and the moving average moving down, we were looking at taking this to the downside. One of the things that we might consider is the fact that we still have some weakness here, right? And still looking at maybe trading that weakness in the Russell 2000, the impact in the small caps, especially if, and this is where we're going to kind of shift our perspective a little bit. Now let's kind of look at this correlation as well. Russell 2000 stocks, the stocks that make up the Russell 2000 futures market, those stocks typically are very interest rate sensitive. So what I'm going to do while we're just here on this particular chart, just to get a sense, and I don't want to kind of scattershot this all over the place, but I want to get a sense of what maybe is driving this. So I'm going to come up here to our Flask icon up at the top of the page, and I'm going to do one other thing here. I'm going to do comparison, C-O-M-P, comparison. And I'm going to put a comparison chart. Now, we've done this before. We just did this with that intraday comparison. But I'm going to put on here a comparison, and I'm going to go to the gear icon, and I'm going to change the symbol that we're comparing this to the /10Y. This is the micro 10-year yield futures. This is interest rates. This is the kind of interest rates, the mortgage market, the credit card market, the auto industry, intra-bank loans, those types of things tends to focus on that 10-year yield time frame, kind of in the middle of the yield curve, if you want to think about it from that standpoint. So we're going to see this futures, right? And we're going to click on the 10-year. Click on OK and apply and OK. And what's going on with you can see almost this inverse correlation, right? Between, especially over the course of the last 2 or 3 months, when yields, that's the purple line, are rising, Russell 2000 futures are falling. Yields falling, Russell rising. Now yields are starting to pick back up again, and we see that Russell ticking back down. So that would suggest, right? That would suggest that in this particular case, maybe we see a little bit more weakness in the Russell, given the fact that the yield is moving. Now, look, here's the thing, and I totally get it, that making a decision to trade based on the movement of one thing versus the movement of another becomes kind of like balancing on a beach ball, spinning a plate on top of a, well, maybe if you're balanced on a seal. Okay. Anyway, you get the idea that there's some shaky correlation, but at the same time, you can see that there is some of that inverse relationship here. So yields going higher, Russell moving down, even though we see the 200 still moving higher, we see a little bit of weakness here in the Russell 2000. Okay. All right. That being said, right, and Christian asks a great question. Why trade the futures, right? What makes trading the futures more advantageous than trading the regular index? Well, we can't trade the index, right? We can't buy or sell the index. So the way that we can only buy, that we can take advantage of that movement is to trade options on the index or trade the futures contract, right? So that's one of the reasons why some traders may use the futures, because it's a direct correlation. It's a more direct correlation there. So we're going to go back to our monitor tab here. We're going to stay with our short position on the E-mini, the micro E-mini Russells, expecting that we're going to see perhaps some more downward movement until we don't, right? So we're going to leave that on there. We've got an alert here in this particular case, and that alert is if this goes to or above that 280. Let's see where our market is, 2190. So that was our target to get out, is if this goes to or below 2190. So we'll keep that in place, right? And we'll keep that alert going in this particular case. Now, let's drop in a little more specifically here. Let's go back to our charts. I'm going to change my chart now to our futures grid, kind of this shorter term grid, and we'll take a look at /M2K. That's the one that we were just looking at. Oh, wow. So notice what's going on here. It's kind of popping as the cash market opened, popping up to the upside here. So that's why we're seeing that kind of initial move in the opposite direction. But notice what it's also doing. It's doing this without a lot of momentum and conviction behind it. It's got a downward moving MACD. The MACD is a technical indicator that looks at a difference between two moving averages and then smooths that out. So we kind of have a little bit of a resistance level right here going on around this 2286 mark or so. And maybe even up into this range, maybe let's call it 2287 as a resistance level. That might be something that we maybe want to pay attention to if this starts going back up against us the other direction. But at the moment, notice that momentum is turning negative once again, starting to see some of that downward movement. So this pop may be short-lived in this particular case. All right. All right. Now, let's kind of, while we're here on this grid, let's take a look at a couple of other things. And one that I wanted to look at really quickly here, and we have a position, let's go to our monitor tab, is gold. In fact, we have the micro gold futures contract, and it has been moving up for us. It's starting to back off a little bit. This is trading that strength in gold. You remember we saw that gold had been pulling back, but it started to rally back up again. So let's go to /MGC. The big contract is /GC. The micro contract in this case is /MGC. If we open up this grid, we can see that our contract notional value size on the micro itself, 29,266. So these are still, even though this is the micro contract, this is a fairly large notional value contract. /GC, you can see the difference here, 292,000 notional value. So let's go back down to the micros. /MGC, smaller contract size on the 1 year basis, continuing to move higher, although maybe running into a resistance. So let's go back down to our cells here, and we'll pop down a little bit. We can kind of see this rolling over. So our current position in this particular contract is long the gold futures. And that's why, since we're seeing that little bit of a rollover, why we're seeing this back off a little bit. We're up about $500 so far. We put this trade on last week, entered the trade at 28.74. We're now at 29.25. So let's go back to the chart here, and what we've seen happen here in the last few days, this is today, 15 minutes, just kind of like we were looking at before, is we're seeing some weakness today. So there's a point at which I want a trader potentially might look at exiting this position. And we might say, look, if this breaks below this kind of horizontal support level, where we saw this bounce happening, that might be a point at which we would exit this position. Now, we can do it a couple of different ways. We could simply put an alert that says, boom, let me know if this breaks back down below that level, and then I need to do something. That requires that we actually do something. And so that puts the onus of responsibility back on us. And we might not jump right in and do something. That's the challenge. So we might miss it, especially if it's moving quickly. So what we could do is we could come in here and put a closing order in, put it in as a stop, recognizing the limitations of those stops, right? Recognizing those limitations of the stops, right? So let's do this. Let's go back to our monitor tab, and then I'll come back, Christian, and I'll try to answer that question again, because I think it's a phenomenal question to ask as part of this discussion. So we know, let's just real quick line this out. We know that our support level is down here right around 29.10. I'm going to call it 29.10 as our point at which, if this triggers below that level, I want to get out of that trade, simply because it's backing off more than I want to be willing to let this trade go against me. Ideally, we see this move higher and kind of break back out, but we're starting to see, again, in the last two 15-minute candles, some falling off in terms of momentum, starting to pull back a little bit. The CCI, the Commodity Channel Index, still showing strong trend, still showing a significantly strong trend, but that's on the yearly chart. So let's go back to our monitor tab. We're going to go back to this MGC contract / MGC contract, and 29.10 is going to be our exit point. So what I'm going to do is I'm going to do right click, create a closing order, and we're going to look at selling this contract, but we're not going to just sell it at a market order or at a limit order. We're going to change this to a stop. Now, recognizing that this stop is going to get worked very likely based on those protection points. So 29.10 is our trigger price. That's the price that we can specify. Okay. We can't specifically, even with a stop limit order here, we can't specifically specify at what price this is going to get filled. So we've got to be willing to expect that it's going to be worked by the exchange as a limit order. And it could potentially, if the market moves quickly, if this gold market goes lock limit down, that order could get rejected by the exchange and not fill. So you got to, this is something that you can't, as a trader, especially a trader of futures contracts, especially as volatile future contracts like metals, you can't ignore. As I've said this before, as Stephen Sondheim says in his musical Assassins, attention must be paid. So we got to pay attention to this, especially if we put a stop order on there and we think that it's going to take us out of the trade. So we're going to put this on. We're going to make that good till cancel, because it might not happen within this current day. We might get a pop up and then move back down, but we're going to click on confirm and send. We're going to read through this order, make sure that it's what we want to have happen. Stop at 29.10 to close us out of the trade. We can see that it's a closing order, recognizing that there are exchange fees that must be paid in this trade if, in fact, it triggers. And we're going to put this order, match this up, and we're going to put it in our futures group if it fills. We're going to go ahead and click on send. And now that order is out there. We can go back to the monitor tab and we can see that that order is out here on that position, right? All right. So, and you could absolutely see, yeah, you can make that a trailing stop if you want as well. Great question. So I want to come back to Christian's question, because I think this is an interesting question, right? Kind of an establishing question, right? So the future value of an index makes the whole index tradable instead of only single companies within it tradable. Let's see. Okay, so this is kind of, again, a fundamental question. So I'm going to go back to the charts, and I appreciate the question, and then we'll jump back in here. So I'm going to change my grid really quickly to, actually, you know what? Before changing this, I'm going to pop over to I've got my demonstration, my other demonstration account pulled up here as well. So this is SPX, right? And SPX is the index for the S&P 500, meaning the value of this index, right? This 54, that value of this index is based on the cap weighted value of the position or the equities in the S&P 500. And if we were to go to, say, for instance, our Market Watch tab, and we go to visualize and we visualize the S&P 500, we can see the 400 and some odd stocks that make up the S&P 500, right? This is the index. But if we go to the trade tab for the SPX, well, we see that here in the trade tab for the SPX, we can't, if we were to click on the bid or the ask for this index, it says instrument SPX. The index itself is not tradable. It's not a tradable index or instrument because there's nothing to trade. It's simply a value calculated by looking at the value of the components of the index. So how do we trade that? Well, you could use index options. You could use an exchange traded fund that is comprised of the index or tracks the index, or we could come over here to our futures market and we could take a look at /ES, which is the futures contract. And if we wanted to trade the performance of that index, because this futures contract is based on the value of the index itself and is a tradable instrument. If we wanted to trade this long, we could go to the trade tab and trade /ES and take advantage of that tradable perspective. This futures contract is tradable. We can go to the ask price for the futures contract and we can click on it. We can create an order and we can buy the futures contract, or we can sell the futures contract that tracks that index. So it's another tracking product that is tradable. We can also trade options on the futures if we wanted to, or if we didn't want to do that, we could come over here and we could do /MES, which is the micro E-minis, and we could trade that long or short. So the index is the value, right? Of whatever its composition is, not tradable. Index options are tradable. Index funds or ETFs are tradable. Index futures are tradable. Options on index futures are tradable, but the index itself is not a tradable instrument. So that's why we kind of look at this as this kind of ecosystem of how do we take advantage of that movement by using the instruments that we can trade, tracking something that we can't trade. So hopefully that helps to kind of clarify that perspective. All right. So now the other thing I wanted to look at here really quickly is what's going on with crude oil. And we've had, in this particular case, so we've got gold. We're sticking with that gold perspective. I want to come back here and I want to look at my chart and I want to look at /MCL, which is the micro crude contract, right? Okay. So this is micro crude, and notice what's going on here, right? So this is the same movement. It's a different instrument, but it's the same movement based on crude oil as /CL, which is the large contract. Once again, if we look at our notional value and our contract size, notional value here is $7,301. If we were looking at /CL, notional value is 72,990. Tick value changes, point value changes, /MCL, smaller tick value, smaller point size. Tick size is still the same, but the notional value is smaller. So now let's restore our grid. And we talked last week about the tendency of these flag type patterns, right? The flag type patterns making that move more than 50% down in that pullback. And you can see where this pulled back to, right? And we talked about the fact that when we see a pullback below that 50% level, if this was our flag bounce move, pulled back below that level, that oftentimes this becomes a bear flag situation. And so that seems to be, on the shorter term chart, almost what's happening here, right? Price rallied up to about that 50% level, seems to be falling off, and we seem to be seeing some downward movement in this micro crude oil contract today. So it seems to be showing us some negative momentum, seems to be moving to the downside. And so we might look at trading this down to this level, perhaps in this case down around the 72 mark, not necessarily looking for a big move to the downside. So what we're going to do is we're going to put on a trade to the downside, right? Trading this to the downside. We're going to stop the trade out if it goes above the 73.62 mark. And we're going to close this down if it goes below 72. That's our target, 72.30 to the downside, 73.60 to the upside, and we're going to look at getting short this contract. So we're going to do this. I'm going to right click, sell custom with OCO bracket. And now we've got our information up here. Now, again, remember, we're going to keep in mind the characteristics of stop orders on futures contracts. So our target to the downside would be buying this back at a limit of 72.30 or less. So we're going to buy this contract back at a limit of 72.30 or less. We're going to make that good till canceled. And we're going to exit if this goes against us, meaning going to the upside, above 73.62, and recognizing that this is going to be a stop. So there are some characteristics of those stops, like we've talked about, that may get us out at a different price. So we have to be paying attention to this. And I'm going to make that one good till canceled as well. And we're going to get into this contract where it is right now. And I'm going to go ahead and click on confirm and send, read through this order. We're going to sell the crude oil contract. This is the micro crude contract, 72.91. Buy it if it goes down to 72.24. And we're going to buy it back if it goes up against us to 73.56. And exchange fees that we need to pay attention to, we're going to go ahead and click on send and fire that order off. And we might need to work that order a little bit because it moved. There it goes, 72.93. We're in, and we've got our stop up here. What I'm going to do is I'm going to put an alert here, and I'm going to say, fine, let me know if this goes above 73.62. Play a sound, send me a text, and we're going to click on that alert. And then here's my alert down here. Right click, create an alert. If this goes at or below 72.34, and we're going to create that alert down here so that I can pay attention. Why are we selling crude? What's the direction that it's moving in this particular point? Now, no guarantee that it's going to go lower, but look at what crude is doing right now in the 15-minute chart. Crude is bouncing off of a resistance level. We can see that played out right here, and we're seeing weakness and strong downward momentum. Okay, this is a bearish trade in the short term. Okay, all right. Okay, so that's where we are with this. Let me kind of summarize what we've done, and I'm going to show you some additional resources, because I notice that there are a lot of new folks here, which is phenomenal, and thank you for being here. But here's what we've done. We continued to stay in our micro gold futures long position, meaning we're expecting the price of gold to continue to go higher. But we put a stop order on it in case it goes against us, recognizing that there are risks with just placing a stop in a futures contract. We stayed short the Russell 2000, given the fact that interest rates were rising. That was our /M2K micro Russell futures. And we're staying long corn, and we are going short. We went short the micro crude contract with a stop and a potential profit target. Okay, this is a short-term trade, right? This is a short-term trade, regardless of what the longer-term perspective is. We're trading that in the direction of that short-term momentum movement in terms of that move. So things might change, and that's why we've got that stop loss, John. You're absolutely right. Now, here's what we're going to do. I'm going to show you some resources. We're going to pop over here really quickly to Schwab Coaching. So go to schwab.com/coaching, and that's where you're going to see our forward calendar of webcasts, and you can learn more about futures and other strategies. But here's the resource: Trader Talks webcasts on YouTube. Click on subscribe if you haven't done so already. You're also going to see it down at the bottom of the page here. And if you type in futures, now you're going to see the whole futures trading playlist. You're going to see individual webcasts that we've done. In fact, here's the one that we did last week where we talked about gold, oil, and equities through a tariff lens. So you're going to see all of those. some specific breakdowns. Michael's done some stuff spotting trends with chart indicators. So a lot of stuff that you can use in terms of resources. So let me pop back over here really quickly once again. And again, my thanks to Michael Fairborn. We talked about futures contracts. We discussed aspects of futures contracts. And we placed a couple of illustrative example trades. This is being recorded. It will be available shortly, hopefully, and we'll get that recording posted. My thanks to Michael Fairborn for helping out. My thanks to our great production staff for helping out as well today. And thanks to all of you for being here. Make sure you click on that subscribe button, click on that like button as well. And we will see you guys again next Tuesday, if nothing else, very soon in other webcasts. Have a great day, everybody. Take care. Bye-bye.